Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to John Teixeira, and at this table, we are TPM.
We are always TPM at this table and other tables.
And this week, we are back to discuss and just reflect on 2024, our last podcast of 2024. So we are just going to talk about 2024.
Yeah, exciting topic, isn't it?
Yeah, it's the most exciting of
Real
topics.
estate in 2024. It's been different. It's been challenging. It's been different. And
because the next time we talk, we can talk about 2025 in 2025, right?
Yes.
Yeah, see
Yes.
the way that works?
Yes.
Well, we want to express gratitude to our listeners of 2024 and to the future. Thank you for listening to us babble, and we hope that anything we've said on here has helped you in your lives or building wealth in real estate. So, especially what we've said in 2024.
You know, that's a really good point, Kyle, because we don't sit here and do this for any other reason other than to provide some nugget of thought for somebody, inspiration, something, right? We don't have all the answers. We don't know everything. We don't come here thinking we know everything. But if we can help somebody and inspire them to do something toward building wealth with real estate, which is what our expertise is. Ran out of breath there. Then that truly is what we're grateful for.
Yes, we're going to just discuss the market results, like market trends of what occurred, some challenges of 2024, so that way we can plan accordingly going into 2025, because a lot is set to change. So on the national stage, in the real estate market, on the national stage, what's been the talk of 2024? It seems to be the same as 2023. Pretty much mortgage rates, interest rates.
Yeah, you know, it's funny. I was thinking about this. No matter what starts the conversation, right? When you're talking real estate with somebody, it always ends with, yeah, but real estate, interest rates, right? Yeah, but interest rates, or interest rates ends up being kind of what ends the conversation. And I really hope and believe that where interest rates are now is going to comfortably become the new normal for everybody, and everybody's going to settle into it, because it is where it should be. Right now, it's at a really healthy, it's still below historical rates, right? It's historical average. We just got into the low sixes, I think, the other day. I don't know when you're listening to this, but we're here in, mid-December, late December, and it just got into the low sixes. It could go a little bit lower, but I don't anticipate. Yeah,
I mean, it's really, we can only be as confident in interest rates as the Fed is, right? Yeah. And I think confidence got too high, so the chairman of the Fed came out yesterday and actually just wanted to poop on everyone's parade there and say, we're only going to cut rates twice next year, and here's a quarter point. And but that's what they do. They're supposed to lead with conservatism, so and that's what they did. So the market maybe got ahead of itself, but mortgage rates have been going down. I think in aspirations for the change of presidency, I think has something to do with it, because the markets have definitely been showing that. His last term was very real estate friendly, very tax friendly on real estate. So yeah, I think those things all impact what's going on as far as, because mortgage rates are a lot like the real estate market. They're a market based. The market sets them, right? So I mean, the Fed sets the borrowing rate, but the market still sets the mortgage rates. So.
Well, yeah, and to your point, I mean, this may be a little bit off topic of interest rates, but it also is what the new administration does is it changes consumer confidence. And I say it that way because I don't know I think it increases it, but it doesn't matter whether it increases it, decreases it, it changes it, right? And changes the way people feel about getting into real estate. No matter what side of the political fence you're on, people that are like-minded tend to invest in real estate, if that makes sense, right? You know what I mean? Like, and they have their ear to what's happening with the tax laws and what's happening with interest rates and how are they going to make their money go the farthest, right? And so when everybody's of that same mindset and things are happening that are helping the normal guy like you and me be able to do that, then that's when consumer confidence goes up and it changes or shifts.
And it gives incentives. It gives incentives to do those things in those markets, which can be very helpful.
And interest rates go a long way. Since we're talking about interest rates, they go a long way toward helping with that, right? It's just my opinion that they're not going to go with that down that much. It's also my opinion that they shouldn't. And this is a longer conversation, but if you take a big...
there's also the argument of the national debt, so that's a factor we haven't really had as much of an impact in pretty much all of our previous markets that does today is federal interest rate is what they're paying on bonds. So, they're dishing out tax dollars to bondholders based on that interest rate. So it's in an interest of lowering or decreasing the rate, the national debt increases is a new argument for why they need to go down, which I could say just makes the Federal Reserve's job harder, but the Federal Reserve makes their own job harder all the time. So
wouldn't you want? I thought you wanted it to go up. Bond rates go up as interest rates go down. I believe they do the opposite.
Mm-mm.
Okay.
That's what the federal funds rate, that's what they're paying you on interest. That's what they pay on.
All right. Don't listen to me on that. That's what I've always been told, and that's what I always thought.
Well, it's still a market, but it's based on that. So when interest rates are high, they're paying high on bonds. That's why high yield market savings right now are doing so good, because those are all backed by bonds. That's why you can stick your money in an account right now and get 5% pretty easily, where back in 2020, good luck doing that, which... when everything was at zero, that's why so much money poured into assets. Yeah. So, you get this tug and pull. So in 2024, we saw a huge change in supply and demand. Inventory levels increased 90% across all major U.S. markets. This is actually was more about leading us to a more balanced market, because when these shifts happen, you could have crashes. Everybody was worried about the crash of 2024. They'll always be talking about the crash of the following year, right? I'm sure you can already find it of 2025. But corrections are necessary in these markets. So this is increased competition. So if there's twice as many houses out there when you're looking than there was a year ago, then you now have more options. You can be more open about what you want, possibly, and it could even be at a better price. So...
yeah, the fact that supply went up 90% this year and it still sucks, that says a lot about the future. That says a lot about the pent-up demand that's going to erupt at some point when all the economic factors come together in the right way. We're going to see another crazy market at some point in the future.
Median home prices have still gone up. Usually when supply starts increasing at this rate, you at least get stagnation in pricing, which in a lot of markets you have. I think in our local market we have, and I don't just think, we'll tell you about that. So, but across the U.S., the rental market growth flattened, slight annual decline of 0.2% in median asking rents. So that's the correction to the rental market that we've been talking about coming, and needing to be competitive in these markets, which 2024 has definitely been one that you have to stay competitive. Overpricing is not working. So
we've talked a lot about that this year on our podcast.
So regionally, we're in Texas, so we like to talk a lot about Texas. So comparing this, Texas actually had a more volatile market, 7.1% decrease in home sales compared to month over month. So that indicates directly market adjustments, because I think it's because we also saw a much higher increase than the broader markets in the years prior. So, but 1.5% decrease from Q3 of 2022 to Q3 of 2023. So that's not huge, but it does show a cooling.
Well, that's a median home price that you were talking about, the 1.5. The 7.1% decrease, though, is just number of sales. And so those are attributed by two different numbers. I mean, they correlate a little bit, but the number of sales can be attributed to a whole bunch of stuff. We talked about supply needing to come up, right? And even though it's come up 90%, it still hasn't come up near enough. Interest rates, we talked about before that, are keeping people from doing too much. Everybody's got these low interest rate loans and they don't want to sell their home, right? Because they have these low interest rate loans, sorry. So those things are all attributing to the fact that we have such a decrease in home sales. But that also correlates into the slight decrease in the median price.
Yeah, so I mean, altogether in both markets, I think we've seen at minimum a cooling off. That wasn't, and not in all cases that means it's not still an increase. It's just not. It's a cooling increase or even a stagnation because
it's slight. Yeah.
Because you can't have booms every year. No, everybody should know that's never going to be good.
It feels like everything's been at a really healthy level, and people just forgot what a really healthy level was like. Because we've come out of a crazy boom period from 1996 through 2007, 2008 was a crazy period, right? And then 2008 to 2012 was a crazy period for all the different reasons, right? And 2012 to now, to COVID, let's call it, right, was just as crazy. We've just had this up and then this down and then this back up, and it's like right now for the past couple of years it feels like a normal market. People are being forced to work and understand what a normal healthy market is like, and that's kind of what we're sitting in right now.
Yeah, I mean it's more balanced. I wouldn't call it normal.
But more balanced, more neutral, neutral,
more balanced market. So we'll see where it goes in 2025. I think just consumer confidence and a lot of these things are based on sentiment. I think we'll be seeing a increasing. I think we'll maintain a balanced market. I think we'll see some increases going in 2025. So economic factors that affected 2024, the big two. One we talk about more is inflation. So persistent inflation, regardless of what.
I have a Tesla. I don't buy gas.
Home price is still going up, right?
Yep.
That's inflation. So
yep.
We're not going to talk too much about inflation, but it has definitely affected market dynamics and people's affordability in both markets, in the rental market and pretty much everything else. So you don't buy gas, so we can't talk about that.
But I buy everything else, and everything else is just as expensive as gas, so I get it.
I'll tell you what did happen in Texas in 2024 for non-gas payers. They added a tax.
That's right. They added $250 a year tax to make up for what they weren't getting in gas taxes.
Yeah.
I figured it out, and almost dollar for dollar correlates to what I would have paid in gas taxes throughout the year if I was buying gas.
Yeah?
Like almost the exact same amount.
But you got to add in the tax that you're paying on the electricity that you're using.
Yeah.
Because they don't account for that, right?
Yep. Nope, they don't. But apparently that tax is supposed to go straight to road, which Texas is pretty good about that. Other states are not, but Texas is pretty good. If they have a tax that's slated to go to a certain thing, it usually goes there.
Yeah. Is that a federal thing?
There is a federal tax, but most of it is state.
It's true. I was going to say
there is a small federal tax, but
Department of Government Efficiency going to slash this EV tax? Probably not.
Oh no, the EV tax is definitely a Texas thing.
Yeah, that may be controversial given who's running that department. Technology, so AI integration was huge in property management and really the whole rental industry this year. We saw a good adoption of more not just AI, but integration technologies like to make things more efficient, really with screening, maintenance. You're seeing a lot of coordination things have AI assistance. So
how about reporting? Seeing a lot more reporting of rents, both good and bad, which I think is a good thing for people. It's making it better and easier for us as property managers to be able to see
fraud prevention, because it's it's kind of like AI fighting itself. If you need something AI worthy of finding fraud that AI made, not when you can type in generate some pay stub documents for this time period and get it in 3 seconds. So
Truly is crazy the things we've seen this year.
yeah,
That's probably
I can make mistakes too, though. So yeah,
you know.
I'd say it's human, but that would be a controversial topic, right? Like virtual tours, though. Virtual tours has become really since COVID, but it's stuck from the COVID years, I should say, that everybody uses virtual tours now, and if it just makes it easier for the consumer to do it during a time period that works best for them.
Mm-hmm.
So we've seen that huge adoption in 2024. So, but what do you talk about on this podcast? We talk about building wealth through real estate. So, what's worked 2024?
What's worked in 2024? Well, people that, you know what they say, Warren Buffett's big about this, right? When everyone else is running away, run into the fire, right?
He said, when people are greedy, be fearful. When people are fearful, be greedy.
I put my own spin on it.
You did.
I put my own spin. I'm thinking about the buffalo that runs into the storm, right? Like Dave Ramsey tells us, be a buffalo.
Running into a fire, though, there's greed and then there's stupidity. So that's Warren Buffett does.
We're throwing all kinds of adjectives out there. We're going to use them all. Let's use them all. I'm sure we can find some more. But the point being that people that weren't fearful probably took advantage of some opportunities this year, right? Because there were some opportunities to buy. If you needed financing, yes, the interest rates are a little bit higher. You know, I get it. But again, real estate is all, one of the basic things with real estate is it's about acquisition, right?
Mm-hmm.
Like if you can get past all this other stuff, you need to acquire real estate. And if this is a good time to acquire real estate, then that's the most important thing. Acquire it. Go get it. Don't worry about all this other stuff that is temporary. Mm-hmm. They created real estate agents coined this new term, when interest rates went up, marry the house, date the rate was a new term that they coined. And, there's truth to it. It's like, the house is going to be there forever. That's the house you want to raise your family in, or if you're building wealth with it, the house is what's important. The rate is going to change, and it can change at any time.
Well, and I almost like the new one of, the old saying of the only two sureties in life are death and taxes.
Mm-hmm.
You can almost add inflation to that, So like it's a guarantee that inflation will occur mathematically based on how our currency works and everything. So buying and holding assets is pretty much the only way to outpace that, right? We saw that in COVID. Anybody who had held real estate won significantly. So,
well, and here's the thing, and I guess this is what I'm getting at, is trying to get people to think long term, right? If you buy now and you get over maybe the not as great monthly cash flow numbers, you get over that is all going to be made up in the long term through appreciation. And we talk about that all the time. But now's the time to be taking advantage of that, because you are in a spot right now, I believe, in the cycle where I don't know how much longer we're going to be flat here, but it's going to go up from here, I believe. At some point, when it does go up, I believe it's going to go up sharper than maybe a little bit more than normal, because the pent-up demand is there. It's been there for 2-3 years.
Everyone's cheering for interest rates to go down. Well, if they do go down, the prices are going to go up. I mean, appreciation is going to go up. That's what's with the supply problem we still have. That's what you're going to see. We know this because that's what you always see, right? Yeah. When interest rates go to zero and you get a 3% mortgage, a lot of properties are moving hands, and that was what happened in 2020. That's why all these things are now locked in, which then has effects in markets with high interest rates. So, buy and hold worked in 2024, even through the high insurance prices and everything. So, flipping properties became more risky in 2024 for sure, because you have declining home pricing. So you have to do it properly. You have to leave more of a gap. If by the time you flip something and buy it, acquire it, get it done 6 months later, the price has gone down by 10%, then you need to account for that on the front end.
Just got to buy better when things are like this. It's really
Which
important.
It helped get deals. It's helped get acquire things in a good manner for the buy and hold strategy. So,
that fear factor we talk about, everyone's been fearful of all these things, and there's not as many people jumping in to try to do this as there normally is.
Yeah.
So people like you and I that have been buying through the year have had an easier time, getting a deal, or, not competing with as many buyers, or, just a little easier.
Well, in the market we haven't mentioned yet is the short-term rental market. So short-term rental market actually saw its bust, I would call it, or its correction earlier than the other markets. We saw that beginning or end of 2022, beginning of 2023 is when that really kind of dropped and supply went crazy and a whole bunch of things, right? So we've seen a recovery in 2024 of revenue, of stagnation of the new supply and demand. So the supply has steadied out. It's not going crazy because when the market busted, you lost a lot of the supply. But it's increased. Demand for Airbnb and short-term rentals has been increasing throughout all of this. So that is where the revenues have now in 2024 market trends have revenue going up again at like 10% year over year. So, that recovery was needed in the short-term rental market. So
that's been one of the bullet points of this year for sure, is how many homes I've seen and shown or sold, right, that used to be an Airbnb, right? That just was a testament to what you just said.
Yeah, and I think it's because it's too early on, especially to say how much Airbnb specifically has an effect on the short-term rental market, if it can be used as a leading indicator, because while real estate moves slowly and takes time for these things to affect markets, Airbnb and short-term rentals is the demand is based on discretionary spending. So, you see very quick and sudden market effects by people's ability to spend money and afford things. So while on the supply side, it's still based on the real estate market and how quickly you can acquire things and all that. So it ties the two together. So if it is a leading indicator, then 2024 tells us that the rest of the real estate market is about to come into its full recovery, right? And like you said, continue to boom.
Yep. And we've talked about on short-term rentals, we've talked about just staying the course, tough it out. It's going to be fine. I mean, I have some that aren't doing that great, but not that great still is a little bit better than breaking me even, doing a little bit better than I would with a long-term rental maybe. So while it's not as great as what we used to in the past, if you just tough it out.
Well, we have few in some areas where we knew we would have toughed it out for 2 years to see the supply decrease because it got oversaturated, and it worked. Now as revenues are going up and you have a limited supply of rentals, now everyone's booking your unit, and you get rewarded because
you've been
for
there the whole
sticking it
time.
out.
Yeah, exactly.
So I guess some lessons learned in 2024. Definitely due diligence. This is weighing risks properly, making sure that your investments aren't solely based on increasing prices, because then when they don't increase, you fail, right? And you could fail big, especially if they decrease. Which when things are easy long enough, a lot of people have done that. But I've seen people not taking the construction costs and all these things that are on the back end when taking in a lot of investments. They've all changed so drastically. So you have to definitely do your research and know the numbers. So, which is really just based on risk management. Market volatility is a thing.
And that's something you should always be doing. It's just what has been more important this year, right?
Yep. So some challenges, 2024, we've kind of talked about all these, but just going through them is rising interest rates. That was definitely a challenge for anyone in the real estate industry has been affected to some degree. There is there's been regulatory changes, which we don't talk a lot about, but there has been definitely regulatory changes in 2024 with real estate commissions and mortgage rates and requirements for what mortgage lenders have to get from you now.
But for the most part, those changes have only been affecting the industry professionals. For the most part, they don't affect the buyers and sellers too much.
In Texas, 2024 was when we saw our homestead exemption go from 25,000 to 100,000. That definitely affected homeowners and primary residences.
Yep.
Just they got rid of PMI this year. I'm just kidding. That would be amazing. I hope one day we can say that they got rid of PMI requirement on. Or
on what?
I don't know.
What do you want them to get rid of it on?
Maybe auto expulsion
what
of
risk
PMI.
Do you want the banks to take?
All of it.
Okay, this is how we got into trouble last time.
Yeah, well, whatever. So going into 2025. So predictions and outlook for 2025. I think while I think we will get lower interest rates, like I said yesterday, Fed meeting, they said they were only going to do 2 cuts instead of 4. Regardless of what those guys say, they live in a different world than the people that they're affecting, right? I think that they're projected to hover around 6, and I think regardless of what those Fed cuts are, they will continue to hover around 6 regardless. So, which home prices are probably expected to grow at that rate still, just not at near the pace we've seen in the last 4 years.
We glossed over this in talking about 2024, but it's important if I can move on to our market here a little bit, because our market is one of the best opportunities in the country, and through 2024 was probably one of the best in the country to invest in, to buy in, to come into, and to be a part of. So while we're talking about challenges nationwide, and we're definitely having the same challenges here in Texas, this region where we are at is still having a boom of big businesses coming in, big industries expanding in our region, people coming in like crazy, and that's good for the housing market in our area. And some may say that's bad for a lot of other reasons. That's fine, but we're talking about real estate, building wealth, and our area is just set up for continuous boom.
Mm-hmm. Yeah, it can't keep up with the supply.
Yep.
That's really what it is. But yeah, so I think 2025 is another positive year. We should you should be able to thrive under the new real estate. Did great under Trump last time, so there's no reason to predict at this point that it won't do great again. So
yeah, and you know what, I feel like he's got lessons that he's learned, and so I'm hoping that he's able to take those lessons learned and do even better, more efficient, right? Get things done faster, more efficiently, do better. He's a real estate guy. Let's not forget that. Who cares more about real estate than Donald Trump? I mean, very few people on the planet do.
I mean, unless you do it every day, it's hard to. You don't necessarily see that there is a lot of regulatory back into real estate. There's a lot of things that we can and can't do. Sometimes for good reason, sometimes for bad reason. That maybe he will change. Maybe he can change some of these mortgage laws that make access to certain things difficult, but hopefully not to the point that we get another 2008.
Kyle wants to he wants to shake up the mortgage industry, huh?
I'm not saying that. I'm just saying maybe a little more freedom on certain things. So,
All right.
But who knows? That's for the little guy. The billionaires don't have those problems, right?
That's right. What should our investors be doing, Kyle?
Stay informed, diversify your portfolios, leverage whatever capital you have as people get fearful, because when people start talking about the upcoming crash in the real estate market and lowering prices or whatever, the more you hear that, the more you should buy. Follow Warren Buffett's advice. If you don't want to follow anything I say, I wouldn't.
Yeah, and I know that
This is not financial advice.
I know, and that we try not to give financial advice, but how about some common sense advice? Like, houses are something that we've been trading for as long as they've existed, right? And we understand them. They're something you can feel and touch, and it's easier to understand where the market's going, where it's been. You know, you can understand all the economic forces that are going to affect the value of your home much easier than you can, let's say, Bitcoin, right? You have to be really into Bitcoin and to understand that. And even then, you can understand it to whatever degree you understand it to, and it could still go in the opposite direction and do something completely different tomorrow on a dime, right? A stock could do that to you. A war could break out and change things in all kinds of different ways. But your house, you know, it's a commodity that's necessary for everybody, and it's easy for us all to wrap our brain around it. That's why I encourage people, take more risk with real estate, less risk with everything else. I'm not saying you should diversify your portfolios and be in a lot of other things, but I just feel strongly that you stay stronger in real estate for that reason.
Yeah, I mean, there's a winner and a loser on every side of money and wealth, right? If you know that rent rates are going to continue to go up and make them less affordable on you, then buy something. If you know houses are going to get more expensive and be less affordable, then buy something now. Do something about it now. So we'll do something about it in 2025. Because, you know, if cost segregation and bonus depreciation rules come back with Trump's new presidency, then you know, people are going to start buying things just for tax savings. You don't even have to understand what I'm saying. I'm just saying if he brings back the same laws that he put in place during his last term for real estate investors, then you will see them buying like crazy again just to offset incomes. So,
yeah.
But this has been great. You guys have anything you want to talk about? In 2025, don't call us in 2024 because you probably won't hear this in time. Just kidding. Call us whenever. Give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com, and we are out.
Later, 2024.